Howdy, folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we'd come to you today with a little bit of a market update here early in the new year. S&P 500 right at about 6930 right now. That is up about 0.7% year to date. Obviously, a very, very young year, so a little bit less meaningful. But I will say, markets having some particularly pretty strong days early on this year, which is always nice to see. Let's talk a little bit about 2025. We'll go through a rundown of some of the indices that were out there. S&P 500 posting a really, really strong year, 17.9% growth in the S&P 500. Which is obviously very, very strong. Bonds also posting a very, very strong year, up about 7.3%, which is pretty impressive given that the yield on the Barclays Ag right now sits at about 3.9%. So still a little bit of juice in the squeeze there in terms of the overall return out of bonds. Russell 2000, that small mid-cap area of the market, having a little bit of a weaker year, up about 12.8% in 2025. I would just note that it started the year weak. And by the way, 12.8% isn't weak. Like, it's weak relative to other indices, but still not a bad year. But it started the year trailing, the large cap space, and then by the end of the year was actually pushing returns, doing a lot better. And then by far and away, the star of the show for 2025 was international. So the MSCI ACWI ex-US. So all the countries in the world, excluding the United States, about 33.2% last year, which is just a monster year. First year in a while that we have seen international markets outperform domestic. And a lot of that has to do with the dollar. The dollar depreciated in value quite a bit in the front half of last year. And if you think about, if I've got a euro and the dollar gets weak relative to the euro, then the euro appreciates in total dollars without even necessarily moving. So a lot of times people will look at foreign markets, for international stock markets, as a proxy for how strong or weak is the US dollar relative to foreign currencies. And I would just note in 2025, it was certainly the case that a lot of the return in international versus domestic was due to the weakening of the dollar. Now, there were some other things, including some economic sort of turning points in Europe, some strong performance by a lot of emerging market countries, whether that's tied to natural resources or whether that's tied to, tech AI bubble or tech AI investments, particularly in China. But we'll just say international had a heck of a year. Turning to more recent headlines, the U.S. is obviously now involved in Venezuela. What exactly that involvement is remains to be seen. I don't think anybody really knows at this point what that's going to look like. However, the market's just shrugging it off. At the end of the day, there's not a lot of active violence happening, which is obviously a good thing. And Venezuela on the overall global economic stage, just not that powerful of a player, not that big of a market. So the market's just sort of, shrugging that off as expected, by the way. Very similar to what we saw with, what happens in the Middle East or what happens in the Ukraine. These which isn't to say that these conflicts aren't important, but it is to say that the market's just not focused on them because it's just not very economically important. The one market that is maybe not true for is oil. Venezuela sits on a massive reserve of petroleum, and would note that under the prior regime, drilling activity, pumping activity in that country had all but stopped. And there is a lot of, I would say, agita in oil markets about what does that look like going forward in the medium to long term. Obviously, oil, a key driver of overall economic activity. Some feeling like if Venezuela got its act together and actually started to put supply online, that would obviously push prices down globally, which would be a good thing for consumers, but maybe a bad thing for the oil and gas industry itself. The U.S. kind of neutral on this stance. We're basically a net non-importer, non-exporter of oil and petroleum. So movements in oil prices affect different industries in the U.S., but don't necessarily affect overall GDP. You can go back to 2015 and 2016 to see that kind of play out. So a lot to be figured out there. And I would just note the impact on the oil market likely to take a while for it to sort of get itself sorted. We got to figure out who's going to be in control of that country. Are they still going to belong to OPEC? A whole bunch of things to sort of determine what happens with that oil. Last but not least, on the horizon, we have a whole lot of labor reports that'll be coming out this week, most notably the employment report coming out on Friday, where we'll get an update to both the job creation rate as well as the unemployment number. Expectations right around 4.6% for an unemployment rate, which, as we've said before, is a little higher than we'd like it to be. I think all eyes will be on that number as the Fed gears up for its January meeting and decides what it wants to do with interest rates. Widely expected that they are on hold until they see the economic data play out. But obviously, the January employment report is a very important piece of economic data. So all eyes will be on that. With that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a fantastic day, and I look forward to talking to you again soon.